China's digital yuan just sparked America's $318 trillion debt collapse. Don't sell yet. January 1st, 2026. The exact moment your retirement account became part of the biggest financial experiment in human history. Not because of a stock market crash, not because of some dramatic headline you'll see on cable news, but because of something far more dangerous: mathematics that stopped adding up. 38 trillion. That's the number politicians talk about. But the real number, 318 trillion. And it's not collapsing tomorrow. It's collapsing right now, so slowly that most people won't realize what happened until it's already too late. Welcome to Boring Currency, where we discuss the financial shifts that aren't boring at all. They're just presented that way until you understand what's actually at stake. Now, before we go any further, if you've reached a point in life where you value substance over spectacle, where you'd rather understand what's happening than be entertained by noise, then consider subscribing to this channel. We're building a community of serious thinkers, not thrill seekers, and we'd appreciate having you here. Also, drop a comment below and let us know where you're rewatching this from, because what's unfolding right now is just an American problem. It's a global recalibration, and your geographic perspective matters more than you might think. Now, let's talk about what really happened on January 1st, 2026, and why the mathematics behind the global financial system just broke. Your retirement account just became part of the biggest financial experiment in human history. Everything you've saved, everything you've built, every dollar sitting in your 401k sits inside a system that's quietly breaking down, not because of a stock market crash, not because of some dramatic moment you'll see on cable news, but because of something far more dangerous: mathematics that stopped adding up. January 1st, 2026 marked the exact moment this became irreversible. On that day, China activated something that sounds boring and technical: an upgraded framework for their digital yuan. But here's what nobody's telling you. This isn't about China getting more powerful. This is about America's debt becoming impossible to finance, not tomorrow, not in a single catastrophic event, but through a slow, methodical erosion that already started. And the $318 trillion number, that's not the national debt most people talk about. That's something far worse. When you hear politicians talk about 38 trillion in national debt, they're only telling you part of the story. It's like looking at your credit card balance while completely ignoring your mortgage, your car loan, your student debt, and that promise you made to pay for your kids' college education. As of January 7th, 2026, total gross national debt stands at $38.43 trillion, but that's just money America already borrowed. It doesn't include what America promised to pay. Medicare alone has an unfunded obligation of approximately $52.8 trillion over the next 75 years. Social Security adds another massive chunk. Federal employee and veteran benefits $15 trillion. When researchers calculate the complete picture, including unfunded obligations to future generations, the federal fiscal imbalance reaches $162.7 trillion. Add state and local government debt and unfunded pension liabilities, and you're staring at well over 200 trillion in total obligations. Some estimates push the complete liability picture north of 300 trillion when you include all long-term commitments, contingent liabilities, and the present value calculations of future shortfalls. This is the real number, not 38 trillion. Somewhere between 200 trillion and 318 trillion in total obligations when measured properly across all levels of government and time frames. Here's why this matters. America doesn't have a debt problem. America has a financing problem. Every empire in history shared the same fatal weakness. They all depended on other people being willing to lend them money. Rome, Spain, Britain, every single one collapsed when the mathematics stopped working. America seemed different in one crucial way. We convinced the world they had to use our system. If you wanted to buy oil from Saudi Arabia, you needed dollars. If you wanted to trade with Europe, you cleared through American banks. If you wanted to participate in the global economy, you had no choice but to hold US Treasury bonds. This wasn't coercion, it was convenience. The dollar was simply the best option available, the most liquid, the most trusted, the most widely accepted. But here's what changed on January 1st. China just made convenient optional. The digital yuan isn't trying to replace the dollar everywhere. It doesn't need to. It just needs to create a parallel system where countries can bypass dollar-based settlement when it's more efficient. And that's exactly what's happening right now. Think about what that actually means. For 75 years, every major transaction in the global economy touched the dollar system. Every oil purchase, every international trade deal, every central bank reserve, all of it created automatic demand for US Treasury bonds. That demand allowed America to borrow enormous amounts at extremely low interest rates because there was literally no alternative. But now there is. Not a perfect alternative, not a complete replacement, but an alternative nonetheless. And in finance, the existence of an alternative changes everything. When you have only one option, you accept whatever terms are offered. When you have two options, you negotiate. When countries can choose between settling in dollars or settling directly in digital yuan, they suddenly have leverage they didn't have before. And every time they use that leverage, every time they choose the alternative, the demand for dollars drops slightly. The demand for treasury bonds weakens marginally. and the mathematics behind America's debt becomes slightly harder to sustain. One transaction doesn't matter. 1,000 transactions barely register. But billions of transactions, that's when the mathematics changes fundamentally. And we're not talking about theoretical future transactions. We're talking about transactions happening right now, today, this week. Billions of dollars worth. The system isn't preparing to change. The system already changed. Most people just haven't noticed yet because it happened quietly. Technically without drama or headlines. But the consequences, those are just beginning to unfold. And they're going to reshape everything about how the global financial system operates. Let me show you how an empire actually dies. It doesn't happen with armies at the gates, or dramatic declarations of war, or even economic collapse that makes headlines. It happens in a conference room in Thailand, or a mid-level executive at an import company makes a decision that seems completely boring. He chooses to settle his next payment in digital yuan instead of dollars. He saves 2% on transaction fees. Settlement happens in minutes instead of days. He doesn't think about geopolitics. He doesn't care about reserve currencies. He just saved his company money. And that single decision multiplied across millions of businesses in dozens of countries is how the mathematics of empire breaks down. For 75 years, America had something no other nation in history ever possessed. Not just military power, not just economic size, but something far more valuable. Involuntary participation. If you were a business anywhere in the world and you wanted to buy oil from Saudi Arabia, you had to convert your local currency into dollars first, then send those dollars through American banks. Then Saudi Arabia converted those dollars into their own currency. Every single step generated fees for American financial institutions. Every transaction created demand for U.S. Treasury bonds because countries needed dollar reserves to facilitate trade, and this wasn't an accident. After World War II, America built a system where global commerce required dollar infrastructure, not because countries loved America, but because there was literally no alternative that worked as efficiently. The British pound had collapsed as a reserve currency. The Japanese yen wasn't fully convertible. The Chinese yen was isolated behind capital controls. Gold couldn't scale to handle trillions in daily transactions. So, the world used dollars, not by choice, by necessity. And that necessity meant America could borrow almost unlimited amounts at incredibly low interest rates. Because foreign central banks had to hold treasury bonds as reserves, they needed those reserves to facilitate their own international trade. This created the most powerful economic advantage in human history. America could run deficits that would destroy any other nation, and the world would continue lending because they needed dollars to function. But on January 1, 2026, that necessity became optional. China didn't build a better dollar. They built a bypass project, mBridge. As of November 2025, this platform processed $55.49 billion in transaction volume. That number increased to 500-fold since early 2022. The digital yuan now makes up over 95% of total settlement volume on this platform. This is to test anymore. Over 4,000 transactions have been completed involving China, Hong Kong, Thailand, United Arab Emirates, and Saudi Arabia, all trading directly in their own currencies. No dollars required, no American banks involved, no treasury bonds needed as reserves. Let's walk through exactly what this means. A company in Thailand wants to buy oil from Saudi Arabia. Old system, Thailand converts spot to $2. Fee sends dollars through New York clearing fee, waits 2 to 3 days for settlement risk. Saudi Arabia converts dollars to reals, another fee. Total cost roughly 3 to 4% of transaction value. Total time 72 hours minimum. Total exposure to dollar exchange rate fluctuations twice. New system using mBridge. Thailand sends digital yuan directly to Saudi Arabia. Settlement happens in under 10 minutes. Total fees less than 1%. No dollar, no American infrastructure, no treasury bond demand generated. Now, one transaction changing systems doesn't matter. But what happens when it's not one transaction? By the end of November 2025, China had processed more than 3.4 billion transactions, worth roughly 16.7 trillion yuan. That's approximately 2.3 trillion US. Real volume, real businesses, real trade happening right now. This grew 800% in just 2 years. And here's the critical part most analysts are missing. China isn't trying to replace the dollar globally. That would be impossible and unnecessary. They're doing something far more strategic. They're making dollar usage optional in specific high-volume sectors. Energy, commodities, regional trade, the exact sectors that historically generated the most forced dollar demand. China is now testing digital yuan in cross-border use in border regions. Hong Kong, Macau, Laos, Thailand, Cambodia, Singapore. Each connection creates another pathway for trade settlement that doesn't touch the dollar system. And this is where the death spiral begins. Not dramatically, but mathematically. Every business that switches reduces dollar demand slightly. Every country that adopts mBridge needs smaller dollar reserves. Smaller reserves mean less treasury bond purchases. Less treasury purchases mean America has to find new buyers or offer higher interest rates or print money to buy its own bonds. All three options make the underlying problem worse. Because remember, America doesn't just have 38 trillion in existing debt. America has to constantly roll over maturing bonds every single week. Billions in treasury bonds mature. The US Treasury has to sell new bonds to pay off the old bonds. It's like paying off one credit card with another credit card, and it only works if someone is willing to buy the new card. For decades, this was automatic. Japan needed dollars for trade, so they bought treasuries. China needed dollars for exports, so they bought treasuries. Europe needed dollars for oil, so they bought treasuries. But now, Japan holds about 1.1 trillion, down from previous years. China holds 756 billion, also declining, not because they hate America, but because they need fewer dollars for trade settlement. And when the forced buyers become optional buyers, the price changes dramatically. This is how empires end, not with invasion, but with invoices settled in a different currency. There's a number that should terrify you: $981 billion. That's how much America paid in interest on the national debt over the last 12 months. Not paying down the debt, just interest, the cost of borrowing. Now, let me show you why that number represents something far worse than most people realize. 5 years ago, in October 2020, America paid $345 billion in interest. In 5 years, the interest cost nearly tripled. Not because America borrowed 3 times more money, but because the cost of borrowing went up. The average interest rate on total marketable debt reached 3.362% today. 5 years ago, 1.552%. The debt roughly doubled, but the interest costs tripled. And here's where the mathematics becomes genuinely frightening. Every time the interest rate goes up by just 1 percentage point, America has to find an extra $380 billion every single year just to pay interest. Not building roads, not funding Medicare, not defending the country, just interest on money already borrowed. To put that in perspective, interest on the national debt now exceeds annual spending on Medicare. It exceeds spending on national defense. America is spending more money on interest than on protecting the country or caring for seniors. And this is stage 1 of the collapse, the invisible debt. Because most people don't see interest payments as a crisis. They see tanks and missiles and hospital beds as real spending. Interest feels abstract until you realize it's eating the budget from the inside. Think of it like a mortgage. If you have a $500,000 mortgage at 3% interest, you pay $15,000 annually. You didn't borrow more money, but your costs doubled. Now imagine your mortgage is $38.4 trillion. Every percentage point matters enormously, and the interest rate is climbing, not because the Federal Reserve wants it to, but because the market is starting to price in risk. This brings us to stage 2, the payment problem. America doesn't just pay interest on existing debt. We also have to constantly roll over maturing bonds. This is the part almost nobody understands. Every single week, billions of dollars in treasury bonds reach maturity. The government has to pay back that money, but the government doesn't have that money, so what does it do? It sells new bonds to pay off the old bonds. It's the financial equivalent of getting a new credit card to pay off the old credit card. This works perfectly fine as long as someone is willing to buy the new bonds. For 75 years, that was guaranteed. Foreign central banks needed dollars, so they automatically bought treasury bonds. American pension funds had legal requirements to hold government bonds. The system was self-sustaining. But something changed. Japan now holds about 1.1 trillion in US debt. That's 3.1% of total debt, down from much higher levels previously. China holds 756 billion. That's 2.1%, also declining year over year. These aren't random numbers. These are the 2 largest foreign holders of US debt, slowly reducing their exposure. Not because they're trying to hurt America, but because they don't need as many dollars anymore. When Thailand can trade with Saudi Arabia using Enbridge, Thailand doesn't need to hold as many dollar reserves. When China can settle energy purchases in digital yuan, China doesn't need to park as much money in treasury bonds. Less buying means the US Treasury has to find new buyers. And finding new buyers means one of 3 things. Offer higher interest rates to attract them, print money to buy your own bonds, or reduce spending to need less borrowing. America isn't choosing option 3. So, we're left with options 1 and 2. Both make the problem worse. This is stage 3, the currency bypass. And the numbers here are staggering. As of the end of November 2025, China recorded 3.4848 billion cumulative digital yuan transactions, or 16.7 trillion yuan. That's approximately 2.37 trillion US. That number grew 800% in 2 years. But it's not just the volume, it's the strategic design. China adopted a strategy combining interest-bearing features with stablecoin-like functionality. While keeping the digital yuan sovereign and regulated, this makes it extremely attractive for commercial transactions. Businesses don't use it because they love China. They use it because it's cheaper and faster. And China is now testing the digital yuan in cross-border use across multiple regions: Hong Kong, Macau, Laos, Thailand, Cambodia, Singapore. Each connection creates another pathway for trade settlement that completely bypasses the dollar system. Imagine you're running a business in Thailand. You trade heavily with China. Previously, every transaction required converting $2, paying currency conversion fees, waiting for settlement, taking exchange rate risk twice, once going into dollars, once going out. Now you can settle directly in digital yuan instant, cheaper, no dollar needed. You don't stop using dollars for everything, but for that one trade relationship, you bypass the dollar system entirely. Multiply that by millions of companies across dozens of countries, and suddenly the daily demand for dollars drops, not dramatically but consistently. This is the bypass, not replacement, reduction. And reduction is all it takes to break the mathematics. Which brings us to stage 4, the confidence leak. This is where everything becomes genuinely dangerous. Markets don't price risk in straight lines. They price it exponentially. Right now, US Treasury bonds are considered the safest asset in the world, the risk-free rate, the foundation of all financial modeling. The yield on the 10-year note finished at 4.24% to 24% on January 16, 2026. But what happens when the market starts questioning whether America can actually service this debt long-term? Not default. America will never technically default because it can print dollars. But what about the real value of those dollars? What about the purchasing power of the bonds when they mature? When confidence starts to leak, and it always starts small, interest rates rise. Not because of Federal Reserve policy, but because of risk premium. Investors demand higher yields to compensate for uncertainty. The 30-year note ended at 4.83% as of January 16, 2026. That's higher than it's been in months. Why? Because the market is starting to price in fiscal risk. And here's the death spiral. Higher interest rates make the debt more expensive to service. More expensive debt means larger deficits. Larger deficits require more borrowing. More borrowing means more bond supply. More supply with questionable demand means higher interest rates. This is the confidence leak. Once it starts, it's incredibly hard to stop without dramatic fiscal reform. And America can't even agree on a basic budget, let alone generational fiscal restructuring. The digital yuan didn't cause America's debt problem. America's debt problem caused America's debt problem. But the digital yuan is accelerating the timeline. By removing one of America's biggest advantages, the forced demand for dollars and treasury bonds, every country using Enbridge needs fewer dollars in reserve. And when countries hold fewer dollars, they buy fewer treasury bonds. And when fewer treasury bonds get bought, interest rates rise. And when interest rates rise with $38.4 trillion in debt, you see the problem clearly. This is a slow collapse. Not because nothing will happen, but because it happens so gradually. But most people won't notice until it's far too late. I can already hear what you're thinking. This sounds like fear-mongering. The dollar has been dying for 50 years. China's economy has its own problems. All true, but none of that changes the mathematics. And here's the part most people get catastrophically wrong. This isn't about selling everything tomorrow. Let me explain why you shouldn't panic and why you absolutely need to prepare. First, markets don't price systemic shifts overnight. The transition from the British pound to the US dollar as the reserve currency took decades, not months, not years, decades. The erosion of dollar dominance won't happen in a single dramatic month. These are slow-moving tectonic shifts. Institutions move last. They have mandates, regulatory requirements, legal constraints. Even if the head of a pension fund sees this coming, they can't just dump all their treasury holdings. The market couldn't absorb that kind of selling pressure anyway. Second, there's no clear alternative yet. The euro has its own structural problems. The yuan isn't fully convertible. Gold can't scale to handle global trade volume. Bitcoin is too volatile for institutional settlement. The dollar remains the best option in a world of imperfect choices. But here's the critical distinction. Best available option is very different from no alternatives exist. For 75 years there were no alternatives. Now there are imperfect alternatives, but alternatives nonetheless, and that changes everything. Third, timing is impossible. You could be completely right about the direction but wrong about the timeline and lose everything in the meantime. The market can stay irrational longer than you can stay solvent. The biggest losses don't come from staying too long. They come from leaving too early, then watching from the sidelines as everything continues to rise for years before the turn finally happens. So, what do you actually do with this information? Understand that this is a transition, not a collapse. The dollar system isn't ending next month, but the era of unchallenged dollar dominance is clearly ending. That transition will take years, probably decades. But it has real consequences you need to prepare for. Watch the interest rate situation extremely closely. Net interest as a share of outlays is forecast by the Congressional Budget Office to be 13.85% in fiscal year 2026, 14.11% in fiscal year 2027, 14.52% in fiscal year 2028. If those numbers start accelerating faster than projected, that's your critical warning sign, because here's the mathematical reality. America can handle $38 trillion in debt at 2% interest rates. That's $760 billion in annual interest, manageable within a $6 to $7 trillion budget. But America cannot handle $38 trillion in debt at 5% interest rates. That's $1.9 trillion in annual interest, more than the entire defense budget and Medicare combined. And America absolutely cannot handle $162 trillion in total liabilities if financing costs rise across the board. Right now, over the past year, the rate of debt increase averaged $8.03 billion per day. That's $334 million per hour, $5.57 million per minute, $92,912 per second. Every second you've been watching this video, America's debt increased by nearly $100,000. The question isn't whether this is sustainable. Clearly it's not. The question is, how long can this continue before the market forces a reckoning? Pay attention to Treasury auction results. When the U.S. Treasury sells bonds, watch the bid-to-cover ratio. Watch the yield. If the government starts having difficulty selling bonds at reasonable interest rates, that's when the slow collapse accelerates into something more serious. Diversify, but don't abandon the system entirely. You still need dollar exposure. You still need some Treasury exposure for liquidity and safety. But having only dollar-denominated assets in a world where the dollar's dominance is systematically eroding is increasingly risky. Focus on real assets and productive capacity. In an era of currency uncertainty, assets that produce cash flow tend to hold value better than pure financial assets. Businesses, real estate, infrastructure, productive farmland, things that generate value, regardless of which currency dominates global trade. And most importantly, stay invested, but stay informed. The problem with the $318 trillion debt collapse narrative is that it makes people think there will be some dramatic moment, a crash, a default, a crisis you can see coming on the news. But that's not how empires actually end. They end slowly. Revenue falls short of obligations year after year. Financing costs rise gradually. Then suddenly confidence erodes at the margins until it cascades all at once. The mathematics breaks down in slow motion until the day it doesn't. Right now we're in the early stages of a fundamental shift. The digital yuan is just one piece, but it's the piece that makes the rest of the changes possible. China is encouraging adoption by integrating the digital yuan into two massive payment platforms, WeChat Pay and Alipay. That's 1.4 billion people getting comfortable with digital currency in their daily lives. When those same people start using it for cross-border transactions and when their businesses start settling trade in digital yuan to save money, the network effects kick in hard. More usage means more infrastructure. More infrastructure means more adoption. More adoption means less dollar dependency. And every 1% reduction in dollar dependency means marginally less demand for U.S. Treasury bonds, which means marginally higher interest rates, which means marginally higher debt servicing costs. Compound that over a decade, and the $38.4 trillion debt becomes a $50 trillion debt at higher interest rates with fewer willing buyers. That's the mathematics that doesn't work. Restoring long-term budget balance would require a 14.6% increase in federal taxes and an equal percentage cut in federal expenditure or some similar combination. Let me translate that into plain English. To fix this problem through normal political means would require raising everyone's taxes by 15%, while cutting every single government program by 15%, Medicare, Social Security, defense, everything. That's not politically possible in America right now, which means the debt keeps growing, which means the interest burden keeps rising, which means the financing problem gets progressively worse. Based on current projections, we have about 5 to 10 years before the interest costs become genuinely unsustainable, before the market starts demanding much higher rates to compensate for the growing risk, before the mathematics breaks down completely. But here's the terrifying thing. We won't see it coming in advance. There won't be a countdown clock on the news. Markets will function normally until suddenly they don't. The digital yuan accelerates this timeline by maybe 2 or 3 years. Not because it's destroying the dollar directly, but because it's removing the forced demand that was masking how serious the underlying problem has become. When people imagine financial collapse, they think of 1929, Black Tuesday, markets down 90%, breadlines and bank runs. But that's not how modern collapses work. In 2008, the market didn't go to zero. It went down 50%, then recovered over years. In Europe's debt crisis, countries didn't stop existing. They restructured. They imposed austerity. They inflated their way out slowly. It's the end of a particular arrangement, the one where America could borrow unlimited amounts at ultra-low interest rates because there were no alternatives. When that arrangement ends, life continues, but it continues with higher interest rates, less borrowing capacity, lower economic growth, harder political choices, a gradual decline in living standards rather than a sudden catastrophe. That's what collapse looks like in the 21st century. Not a crash, an erosion. Every decade, someone predicts the dollar's demise, and every decade they've been wrong. I completely understand the skepticism, but here's what's genuinely new this time. For the first time in modern history, there's credible alternative infrastructure for international settlement that doesn't require dollars, not just conceptually, actually built, actually functioning, actually processing billions of real transactions. Technology exists and works. The network is growing month by month. The incentives align perfectly for participating countries, and the mathematics behind America's debt load is getting worse every single month. Those four factors haven't been true simultaneously in modern history. That's why this time carries fundamentally different weight. Empires don't fall when the debt becomes too big. They fall when the debt becomes inconvenient. For 75 years, lending to America was convenient, the safest, most liquid asset in the world. No alternative even came close to matching it. That convenience is eroding right now, not gone, eroding. The digital yuan isn't making it impossible to lend to America. It's making it optional in ways that didn't exist before. And when lending to the most indebted nation in history becomes optional rather than obligatory, the price of that lending goes up significantly. The mathematics becomes harder. The sustainability becomes questionable. That's exactly where we are now. Not at the edge of a cliff, but on a slope that's getting steeper every month. You don't sell everything today, but you need to understand that the ground underneath the financial system is shifting in ways that haven't happened in our lifetimes. The certainties that governed investing for the past 50 years are becoming uncertainties. Plan accordingly. Stay informed. Watch the interest costs month by month. Watch the treasury auctions closely. Watch the slow march of digital currency adoption across international trade. The collapse isn't coming in some future dramatic moment. It's already here. It just moves so slowly that most people won't realize it's happening until they look back in 5 years and wonder when everything changed. The answer is it changed on January 1st, 2026, when China made the digital yuan a true alternative to the dollar system. Everything after that is just mathematics playing out to its inevitable conclusion. Nothing breaks tomorrow, but the mathematics already broke.